Let's switch to the company that we actually own in our US model portfolio. And of course, that's because we're very close to this investing theme. And this one is the company that we chose at some point many years ago, Stryker, S-T-R-Y-K-E-R. It is principally focused on those hips and knee joint replacements, but it's also a major player in surgical devices. So that means things like the endoscopy tools, the ones that they stick inside you with a video probe on the front to see what's going on in your intestines, to see if you've got colon cancer, and of course all of the keyhole surgical stuff. So some of them have the camera on the front with the little chompers, as well as all sorts of other things. If you go into a hospital basically and look around, pay attention, you'll see lots of equipment in all of the surgical rooms and the specialist theatres and all the rest of it that say Stryker. Market cap 52.5 billion rand. No, what am I talking about? $52.5 billion. Price to earnings ratio 31.1, dividend yield 1.23%. We might as well put up the share chart.
Yes.
Handsome, handsome.
Very nice.
That's all I can say. Look at that, trading at its all-time high right now, as in right now, today, tomorrow, this morning.
That is definitely where you wanted to be invested. You know, when you look at I mean, there's so many things we can talk about on Stryker. The one thing is that I mentioned earlier, they've got what they call now the complete knee, and they've got a robot that can actually now implant the complete knee and a complete shoulder and all of those.
Oh, really? So there's a machine which is designed to install that.
So they did an acquisition of this robotics company 3 years ago. It was sort of a little controversial at the time.
In fact, the CEO, Kevin Lobo, came from Mako, which is the company that does the machines.
So Mako is this robotics company. In the past quarter, they've actually said that they've now installed 18 new robots.
So that's incredible. So what you're saying is they basically strap the customer down, give them a total anesthetic. The machine then picks up where the leg is and where the bones start and finish. It moves in, removes the busted one, and basically does the full installation in one procedure, hands off while people watch it.
So, I mean, the doctor works it with a joystick, so it's basically like a game. But
video games.
But I think, you know, the big thing here is the accuracy in which this computer is able to perform this procedure.
The time that it takes a person to recover from surgery is critically dependent. I mean, in the old days where the guy breaks you open and then starts cutting with a hacksaw, you're going to take months to come right after that. But if they carefully just do minimal invasive surgery, displace as little of the flesh and the muscles as possible, so much better.
Yeah, no, and you know, another thing that I like is of these 18 computers, and this was sort of the trend in the whole quarter's earnings, is the fact that they had stronger growth outside of the US than they've had in the US. They still had strong growth of about 8% in this quarter in the US, but about 10 outside of the US, and they've been predominantly sort of deriving a lot of their income from the US. So it's good to see the diversification, you know, coming from Canada, Australia, Europe, and all of those areas.
Yeah, it's a no-brainer again, because there are more people in those countries now that have the similar degree. When you look at US spending on healthcare, it's very high. It's a very high percentage of GDP, and that's because people that are rich and obsessed with these sorts of things. But it is the case globally that all of the things and the themes we talked about earlier are in fact the case. Okay, what else to say about this company? Well established, nice dividend yield. Interestingly, when we looked at it and invested in it, it had a lower market capitalization because obviously the share price has moved higher, but the price to earnings ratio now is lower than it was then, indicating that solid earnings and solid cash flows come in to support the rising share price.
You know, and that's probably a very good thing to mention for investors, is that you want the earnings to grow into the price, and if it doesn't do that, then be worried, but it did in this case, so it's not a bad thing to actually accumulate more of this company.
Right, good. So we're going to go hot on this one.
Hot, yes.
Still a buy, even at current levels.